Good evening, TheoTrade. This is Coy Rosenblum, and you're watching the Theo Not the Video for May the 28th, 2019. And we're talking mega levels, especially for the S&P 500, which is back into 2800 and the 2811 gravity spot. Just by looking at this daily chart, going back to 2018, we can see the points in time that price interacted with the 2800 level, in this case fell away from it, also fell away from it, and then supported on it, and etc. all through the 2018 into 2019, just to note how important this spot is. And again, we're back into it right now. So if you are putting on longer term positions, this is a key inflection spot. What happens here should determine where the market moves in the next week or the next month. Mainly, are we repeating our 2018 pattern of the market creeping higher and then collapsing lower, creep higher, collapse lower, or is it something different? Since the start of 2018, we've really had two mega crashes, in terms of the S&P at least, falling about 500 points, from 2,900 to about 2,500 or just a little bit lower, and this other one was even larger than that, from 2,900 to about 2,350 in the futures contract. Will this be the third time? Or I guess I should say it's the third time a charm. That's where our positions will be. In tonight's video, we'll take a look at the 2800 level and compare it once again to this July, August, September period of rising price, falling bull volume, rising bear volume, and of course, negative momentum divergences. That's the big picture back then. We can compare that now to this 2019 period. We have similar falling bull volume, rising bear volume, and of course our negative momentum divergences. If we don't worry so much about momentum, focus again on volume. And that's going to be our confirmation or non-confirmation. Maybe this look is a little clearer to see our divergences as the market crashed. These divergences in volume and momentum were in play. We'll take those off the chart for a moment. Let's focus mainly on our price index. This is the last video we had talked about, this triangle and this consolidation pattern. Remember, if you remember correctly, I drew these lines for a bullish upside range expansion or a bearish downside range expansion. And that was done in real time to project or forecast or get ready for a market moving to this 2811 or 2800 level. That occurred, and we've seen at least a short-term bounce, but we are right back into it. So the game plan is the same. Depending on how the market reacts here, which means bulls are going to give it everything they've got to get this market up off 2800. So be prepared for that scenario, meaning a departure or bullish swing up away from 2800 takes us at least to 2865, if not to form a broader trading range to about 2900. That's the bull scenario. We are equally, if not more so, prepared for the downside, which is our bear scenario that triggers under today's prices, 2800 and ultimately 2775. That is our 200-day simple moving average. We can zoom in on that and see this is our downside target if the buyers cannot hold support. That would push the market 25 points lower, and if we get a move under that, 2730, and then even lower than that, 2700, or this 2683 pivot, or maybe even lower than that. Once again, just if we're not looking so much at technicals of the chart, just draw parallels or similarities in an overbought, overextended, creeping uptrend, weakening in volume, and picking up in bear volume. That scenario is playing out again. Will the future be the same? We don't know that. We're just playing probabilities. So again, if the market breaks, expect it to go much lower, 2700 or even 2626. Those would be valid downside targets, and any volatility plays to the long side, buying VIX futures or just buying anything volatility related, buying puts, buying in-out spreads with puts, or any other strategy that takes advantage of long volatility and falling equity prices in the indices, futures, ETFs, or individual names. We'll talk about individual names in a future video. But for the remainder of tonight's video, let's just take a look at the Dow Mini Futures that's already under the 200-day simple moving average. Now, the Dow Futures have a pivot just above 25,000, which was its same spot in 2018, and we're seeing it push down to key support levels. We're comparing it to this initial drop, bounce, initial drop, bounce. Notice that the market fell shy of breaking through the underside of your daily moving averages, held support, and then fell even further. It then went on to fill out or trade within a broader range. That was 24,000 and about 26,000. We're at the midpoint now. So again, if the Dow and the S&P fall, we'll probably see the Dow continue lower to 24,500 or 24,200. In our Nasdaq, we had an even clearer pattern back in 2018. That was a bearish rising wedge. Again, looking at the volume, we see bull volume declining, that's the green bars, and bear volume increasing as price went higher. That's a recipe for disaster, and that's ultimately what happened in the equity market, was a rapid fall. This is where we should be putting on risk twist spreads or any other positions that take advantage of a falling equity market. The time to do that is ahead of the crash, not during it. And the same situation is taking place in 2019, that we have bull volume declining, bear volume increasing, especially during this most recent swing. That's taken it down away from 7,800. So we will be watching all of this carefully into this week and next. Failure to hold the 7,200 level, 7,250, sets up a play towards 7,150, which is your 200-day simple moving average. Beneath that opens up 7,000 or even lower, maybe to fill out the range, which is this area here, down to about 6,600 in the Nasdaq. We'll finish up with the Russell, which has its own sideways trading range between about 1,500 and 1,600. That's been the case for the bulk of 2018, and we will be watching it for downside action. We can draw another trend line here. This is a potential price pathway, of course, to the downside. 1,400, 1,350, maybe even lower than that. Until we get outside of the 1,600 and 1,500 range, expect continuity or bounce action between these spots, but we are ready for a breakdown if that occurs. We'll again finish with the S&P, noting this 2,800 level, 2,811 as a gravity spot and polarity spot. If this fails, we'll quickly see 2,775, and if that fails, we may again be following the pathway of 2018, which is even lower prices at 2,650 or thereabout for a chop or development of a wider trading range. But as always, be careful and be safe. This is Corey Rosenblum with your Theo Nightly video for May 28th, 2019.